Chubb just dropped their Q2 2026 earnings, and honestly, it is a massive beat across the board. Core operating EPS came in at a record $7.26, which crushed consensus and is up 18.2% year over year.
Yeah, and total consolidated net premiums hit $14.7 billion. So that's a solid 3.6% jump right there.
Right, and the stock is reacting exactly how you'd expect because net income hit $2.85 billion for the quarter. But we are doing a deep dive on this official 13-page release today because, frankly, the real story here isn't just about what they grew.
No, it's really about what they intentionally shrank. I mean, they're operating as what they call an all-weather company, which completely defies the standard Wall Street playbook.
It totally does. Because top-line growth is practically a religion in corporate finance.
Oh, absolutely. The prevailing assumption is that bigger is always better. And, actively walking away from market share is usually seen as a sign of systemic failure.
Yet when you dig into this earnings release from July 21st, that entire growth at all costs philosophy gets flipped completely upside down.
Yeah, it's fascinating. It requires immense structural confidence to look at millions of dollars in potential premium revenue and just say, no, keep your money.
Exactly. And to understand how they have the leverage to do that, we kind of have to establish the sheer scale of their foundation. I mean, pulling in nearly $15 billion in premiums in a single 90-day period.
It's staggering.
It is. That's not just a standard business operation. That is a macroeconomic engine. They are basically acting as a giant financial shock absorber for the global economy.
Right, pricing and absorbing the world's risks so commerce can actually function. But a shock absorber is only as good as the structural integrity behind it.
Yeah, fair point.
And you really see the strength of Chubb's structure in how they return value to shareholders. Their preferred measure of value creation, tangible book value per share, that jumped by a massive 17.1% year over year.
Hitting $131.93.
Exactly. And they aren't just hoarding that capital to make the balance sheet look pretty. In this single quarter, they took $1.37 billion of that wealth and returned it directly to shareholders.
Just through a combination of stock buybacks and dividends.
Yeah. Yep. So if you're a retail investor looking at those numbers, you have to be asking what specific operational philosophy is driving that kind of cash generation.
Well, you find the answer to that in a very specific phrase used by the CEO, Evan Greenberg, right in the text of the report.
The long-term compounder quote?
Yeah, he describes Chubb as a long-term compounder of wealth in a cyclical business, and explicitly labels them an all-weather company.
Which is such a great term. Because an all-weather company doesn't mean the sun is shining on every single department simultaneously.
Right.
It means the corporate architecture is engineered to generate strong growth, regardless of the macroeconomic storms hitting specific sectors.
But wait, to be a true all-weather company,
Yeah.
you have to know when to seek shelter. You can't just stand out in the hail and pretend your umbrella is invincible.
Yeah, no, that's a great way to put it.
And I think that directly sets up the tension in how they manage their core property and casualty business, the P&C side, this quarter. Because they made some choices that, honestly, seem to invite punishment from the market.
They absolutely did. Let's isolate the P&C engine for a second. Total underwriting income was $1.94 billion, up 18.8%.
It's huge.
It is. And the efficiency metric driving that income is the combined ratio, which came in at an incredibly lean 83.8%.
And that's an improvement from 85.6% last year.
Exactly. And if you're tracking insurance operations, 83.8% is a fortress number.
Yeah, because it means for every dollar they take in, they are keeping over 16 cents in pure underwriting profit. And that's before a single dime is even invested.
Right.
But here's where I have to push back a little on this narrative of just, constant success. Because achieving that 83.8% required a total bloodletting in certain departments.
No, totally.
If you look at North America commercial P&C, premiums didn't grow. They actually went down by 2.3%.
Yeah.
And if you drill into their major accounts and specialty property, that specific segment dropped a massive 9.0%.
Which is wild.
It is. Usually, if a company reports a 9% drop in a core historical revenue segment, Wall Street triggers a massive sell-off.
Mm.
How is management getting away with cheering for this shrinkage?
Because the noted in the report that they are actively seeing, quote, overly soft underwriting conditions in property insurance globally.
Especially in large accounts and the excess and surplus market, right?
Exactly. And in a soft market, there's basically excess capital floating around chasing too little risk. The inevitable result is that competitors start slashing their pricing and loosening their standards just to keep their revenue numbers up.
So the competitors are effectively subsidizing bad risk.
Pretty much.
They're telling a client, hey, we know this coastal warehouse has a higher risk profile this year, but we'll insure it for half the premium anyway, just so we don't lose the account.
Precisely. It's a race to the bottom, driven by that exact Wall Street pressure you mentioned earlier, the terror of reporting a drop in top-line revenue.
But Greenberg's response to that pressure is just iron discipline. He literally says in the Q2 report, we will not underwrite knowingly at a loss.
Right. They are knowingly accepting a growth penalty.
Which means they are looking at a huge chunk of market share and willingly handing it over to competitors.
Yes, but they are handing over toxic market share. They are intentionally choosing to shrink their North American large property book rather than take on bad risks at inadequate prices.
Right, sacrificing vanity metrics to protect that 83.8% combined ratio.
Exactly. And the beautiful thing about this Q2 report is that it provides immediate mathematical proof that this discipline actually works.
Oh, you're talking about the catastrophe losses.
I am. Total pre-tax net catastrophe losses for the quarter were $475 million.
Which, I mean, sounds like a lot of money out of context.
It does, but it's down significantly from $630 million in the same quarter last year. By having the discipline to walk away from poorly priced property risks in a soft market, they literally shielded their balance sheet from paying out as much when the disasters actually struck.
That is a phenomenal cause and effect.
Yeah.
You shrink the revenue in the most dangerous category, and surprise, your catastrophe losses plummet by over $150 million.
It goes even deeper than that, actually. They also reported $283 million in favorable prior period development.
Up from $249 million last year.
Right.
Meaning the claims from disasters in previous years are actually being settled for less money than their actuaries originally set aside.
Exactly. It proves that their underwriting wasn't just disciplined this quarter when they shrank the book. It's been historically conservative and highly accurate for years.
Okay, but let me play devil's advocate here for a second.
Mm-hmm.
If you're an executive committee and you intentionally authorize shrinking your large commercial property business in North America by 9%, you are leaving a massive hole in your earnings potential. So how in the world did their total consolidated premiums still manage to grow by 3.6%? If the anchor of the business is being hoisted up, something else has to be pulling the ship forward.
And this is where we see the actual architecture of an all-weather company. It comes down to ruthless, highly fluid capital reallocation.
Okay.
If you are a single-line regional insurance company and your main market goes soft, you are completely trapped. You either shrink your entire company and face shareholder wrath, or you write the bad business and just pray a hurricane doesn't hit.
But Chubb isn't trapped because of their global diversification.
Exactly.
It's like a ship's ballast. When a storm hits one side of the vessel, like the U.S. large property market going soft, they don't just sit there and take on water. They shift the capital weight to the other side of the boat to keep the entire operation upright.
That is a perfect way to look at it. Let's break down exactly where they shifted that ballast to offset the 9% shrinkage.
Let's do it.
Even staying within North America, while major commercial accounts shrank, they deployed capital to middle market and small commercial, which grew 8.9%.
Wow, okay.
They leaned into personal lines, which grew 6.0%, and agriculture, which also grew 6.0%. They are surgically maneuvering around the soft spots.
But the real heavy lifting for that ballast happened overseas.
Wow, the international numbers are staggering in this context. The overseas general segment grew by 10.2%.
That's massive.
Yeah, and if you drill down into the specific regions capturing that reallocated capital, Latin America was up a huge 15.6%, Asia was up 12.0%, Europe was up 5.1%.
And we can't ignore the life insurance division either. When people think of Chubb, they almost exclusively think of property and casualty, complex commercial risks.
Right, the big industrial stuff.
Yeah. But their life insurance net premiums written were $1.94 billion for the quarter, up 7.5%. And the segment income from that life insurance jumped 9.0% to $332 million.
And where was that life insurance growth coming from? It was driven heavily by a 13% jump in international life and solid growth in their North America worksite businesses.
So it's basically a financial game of whack-a-mole.
Pretty much.
The moment the U.S. property market gets too risky and soft, Chubb just pops up and captures double-digit growth in Latin America, Asia, and life insurance.
Exactly. And if we connect this back to Greenberg's strategy, this geographic and product spread is the vital mechanism that allows for discipline.
Right.
It means the executive team can look at their North American property underwriters and say, hold the line. Do not write bad business just to hit a quota. We don't need your volume this quarter because Latin America and Asia are handing us double-digit growth.
It provides total structural freedom.
Yeah.
The geographic spread literally funds the underwriting discipline.
It really does.
But here is where we need to make a massive pivot. Because if you're analyzing this report, underwriting efficiency and collecting $14.7 billion in premiums across the globe is really only half the business model.
It's the operational half, yes.
Right, but the other half, the financial engine, is what they actually do with those billions of dollars in premiums during the time gap between when a client pays the bill and when Chubb eventually has to pay out a claim.
Ah, the mechanism of the float.
Exactly. And this brings us to the balance sheet, which is frankly the most staggering part of the Q2 report. Chubb is not just an insurance engine. It is a $175 billion investment behemoth.
The scale of their capital deployment is difficult to fully conceptualize until you see the quarterly yield. I mean, their total invested assets now stand at $175.4 billion.
That's up 9% over the last 12 months alone, right?
Yep. They take the float, that $14.7 billion collected just this quarter, and they put it to work in the global markets.
And it's working with incredible efficiency right now. The report shows pre-tax net investment income of $1.76 billion, up 12.3%.
Which is a record.
And their adjusted net investment income was $1.88 billion, up 11.4%. The report explicitly notes that both of those figures are absolute record highs for the company. So if you're looking at these numbers, you have to ask a foundational question. When a company is generating nearly $2 billion in pure investment income in a single 90-day period, are they an insurance company that invests on the side? Or have they effectively become an asset management firm that just uses insurance underwriting as a cheap funding mechanism?
It's a debate you see a lot in financial circles, especially with companies like Berkshire Hathaway that famously use insurance float to fund acquisitions.
Right, the classic Buffett model.
Exactly. But the reality with Chubb is that they are operating a true dual engine model. The report attributes this surging investment income to, quote, excellent performance in our fixed income and alternative asset portfolios.
Okay.
But what's crucial to understand is why that portfolio is performing so well, and it ties directly back to that 83.8% combined ratio.
Because they aren't constantly draining their reserves to pay out bad claims.
Exactly. A lot of insurers will knowingly take an underwriting loss, a combined ratio over 100%, just to get their hands on the premium dollars so they can invest them.
Oh, wow.
Yeah. It's a dangerous game of arbitrage. But Chubb refuses to play that game. Because their underwriting is so strict, they generate a profit on the insurance itself. That means the float gets to sit in the investment portfolio longer, compounding uninterrupted.
And in a macroeconomic environment with higher interest rates, those fixed income investments are throwing off massive amounts of cash. They're essentially earning record yields on other people's money, while simultaneously making a profit on the service of holding that money.
It is the ultimate compounding machine. When you fire both of those engines at the exact same time, an underwriting engine that aggressively protects its margins, combined with an investment engine earning record yields on a $175 billion UMET portfolio, you get the ultimate metric of corporate efficiency.
And that dual-engine dynamic is exactly what drove their annualized core operating return on tangible equity to an incredible 21.2%.
Right, 21.2%.
That is the mathematical reward for the discipline of saying no. So, to synthesize all of this for you listening, Chubb's Q2 2026 report is fundamentally a testament to the power of holding the line in a cyclical business.
Absolutely.
They achieve record investment income and stellar overall profitability, not by mindlessly chasing top-line revenue, but by leveraging a fortress balance sheet, shifting their global ballast, and having the raw courage to shrink unprofitable segments when the market lost its mind.
It is a textbook example of long-term wealth, compounding, taking absolute precedence over short-term gratification.
But as we wrap up this deep dive, I want to leave you with a highly specific forward-looking thought. Because this earnings report isn't just a victory lap. Management actually embedded a very clear warning about the macro environment.
They did, yeah.
In his commentary, Greenberg explicitly cautioned that, and I quote, soft market conditions are spreading to certain areas of casualty, while financial lines also remain soft.
That is a critical detail for the coming quarters. We saw what they did with large property when it went soft. But casualty insurance and financial lines represent massive chunks of commercial liability.
Exactly. So here is the underlying tension for you to chew on. If Chubb is already stepping back from large property risks, taking a 9% revenue hit in that segment, and now they're actively warning that this pricing softness is infecting casualty and financial lines,
hmm
how much more of their U.S. commercial business are they going to have to shrink?
It raises a vital question about the theoretical limits of their all-weather model.
Right.
If they are forced to apply that same strict rule, knowingly underwriting at a loss to casualty and financial lines simultaneously, the growth penalty in North America is going to get exponentially heavier.
Will the ballast hold? Can their international segments in Latin America and Asia, combined with their life insurance growth, really generate enough momentum to carry the entire corporation if the U.S. commercial market stays broadly soft across multiple major lines?
That's the billion-dollar question.
It's one thing to have a financial shock absorber. It's another to see how much continuous multi-sector impact it can take before the ride gets bumpy for shareholders.
That will absolutely be the definitive test of their discipline in the coming year. Will they keep saying no, or will the sheer weight of the soft market force them to compromise?
Keep a close eye on that combined ratio in Q3. And hey, if you want to keep tracking how these massive earnings reports actually impact your portfolio, make sure to follow the show for our daily earnings coverage. Until next time, keep digging into the numbers.